Hello, everyone. A very good afternoon to all of you gathered here. Today, I am with you to discuss what it takes to be compliant in UAE from a corporate tax perspective, what business owners need to know in order to qualify for the 0% corporate tax, and what are the do's and what are the don'ts, what are the common pitfalls that they need to avoid. So just a little background about how the taxation landscape evolved in UAE. So if we can go back in 2018 when the VAT was introduced, a year later we saw economic substance regulation coming into the picture. Then 2 years later we saw the announcement of corporate tax. In April 2022, we saw MOF, Ministry of Finance, launch public consultation for corporate tax. That was the first time wherein we saw MOF giving industry experts their chance to give suggestions, opinions, advices in order to frame the law. And by the end of 2022, we saw the corporate tax law was issued. Corporate tax, of course, it was applicable in UAE from 1st June 2023. There's a myth behind why corporate tax was actually introduced. People say that the government wanted tax revenue. Before 2018, what UAE was transformed from to what it is today without even having the tax. It's basically UAE was rich. The reason why they introduced corporate tax was just to make themselves aligned with the international tax law in accordance with the OECD guidelines. So OECD, Organization for Economic Cooperation and Development, it was comprised with the G7 countries, then G20, and now we can see that it includes 140 countries. In order to avoid countries from escaping the tax paying thing, UAE also introduced a corporate tax. If there was an absence of corporate tax in UAE, multinational companies would park their profits here and take undue advantage of this jurisdiction. There are two pillars for BEPS, that is base erosion and profit shifting. So the pillar one basically charge companies wherein if they have a turnover of 20 billion or more. But then it faced a lot of US resistance because US government started saying that we are anyways taxing our companies on a federal state level, and if we happen to again have this pillar one into implementation and practice, we would be double taxing them and there would be a lot of taxes, so it would be unfair. So then came into the picture pillar 2, which is global minimum taxation of 15% for multinational enterprises having revenue of more than 750 million euro. So this pillar 2 has been adopted by 40 countries already, and we can see that in UAE now there's a corporate tax of 15% wherein MNEs have to pay that. Now, if we see from the types of taxation, there is residency based taxation and there is citizenship based taxation. If you see citizenship based taxation, it's only for two countries, which is US and Eritrea. So, what it basically says is no matter wherever you are located, wherever you are residing, you have to pay tax because you are a citizen of US. Unlike the residency based taxation, which is in UAE, UK, most of the other countries. So residency based taxation is basically in UAE it is 183 days or more for any expats if you are residing, whereas if you're a GCC national, it's 90 days or more. This basically are the types of taxation. Then if we see also basically there is another basis of taxation wherein it is uh, territorial taxation and worldwide income. So the if we talk about territorial taxation, which is countries like Singapore and Hong Kong, they have this. So if you are originating or incorporated in Hong Kong or Singapore, so they basically do not tax on worldwide income. They say no matter how many banks account you have all over the world, we are going to tax you only on the income that is being received in that particular jurisdiction, Hong Kong or Singapore. Unlike worldwide taxation, which is also in UAE. So if you're a resident company in UAE, so you're going to be taxed on worldwide income. Of course, if you have paid any taxes more than 9% in any other country back there, you're going to get a tax credit for that year. So this is how the taxation framework actually is set up in the whole world. On a very brief note, so I am Denzel D'Souza, your tax consultant for this afternoon, and I'm going to cover firstly the UAE corporate tax registration for 2026, the deadlines, penalties, and how to avoid the 10,000 dirhams fine. Secondly, UAE qualifying free zone persons 2026, the conditions, the five conditions to qualify for the 0% corporate tax. And lastly, how to check if your business qualifies for 0% UAE corporate tax in 2026. So the first part is UAE corporate tax registration for the year 2026. Like any other year, who are actually required to register for corporate tax? One is all juridical persons. Registration is required for all companies incorporated as juridical persons, including limited liability companies, branches, holding companies operating within the country's boundaries, ensuring compliance with the new tax laws. Then comes free zone entities, which are from a tax point of view outside the state. But when it comes to registration, they still have to register. All free zone entities, including qualifying free zone persons, are obligated to register even if they benefit from zero tax rates to maintain compliance with regulations. Then comes foreign companies. Basically, we see this more into as a permanent establishment or non-resident person. So any foreign company with a permanent establishment or nexus in UAE. So nexus, when it comes, is basically means relates to the real estate. Any foreign company holding a real estate here in UAE, so must register for corporate tax, as they too fall under the jurisdiction of UAE tax laws. And one point not to forget, also sole proprietors, that is a natural person who is conducting business and solely business in UAE, need to register for corporate tax once he or she meets the 1 million dirham revenue threshold in UAE. So any other income like rental income, personal investments, salary, these all doesn't require you to register for corporate tax. Only and only business income. Registration is essential for all businesses. Registration is not determined by whether you owe tax. It is dedicated by your status under the law. Every UAE business must ensure compliance to avoid penalties. Of course, uh, let's say you say that I just want to open a license and I don't want to operate in UAE. Basically, this happens mostly with out of scope businesses wherein they have a company here in UAE, but they want to do third port shipment, basically import from a country and then deliver it to another country without touching the UAE base. So even in this case, the moment you have a license, you have to register for corporate tax. What are the penalties for non-compliance? It's 10,000 dirhams penalty, which can significantly impact the business, the financial stability. Mostly we see business owners not doing this on time, and thereby ending up having a lot of penalties and complications from FTA. A lot FTA gets keeps sending you notifications, communications, which again gives the business owners tension for no reason. So in order to avoid all this, it's better you register well in advance and be compliant. So, what are the practical steps to avoid these penalties? Seek the right initial OI advice. So, when I say OI, it's original intelligence. So, nowadays we always rely on AI, artificial intelligence. We search for something on any search engine, and then we try to figure out ourselves. We try to jump to conclusions by ourselves. Yeah. At Safari Star, we have well qualified business setup advisors who actually assist you in creating that impact and awareness. Closing a deal, closing sales is secondary. but primary is to educate the client, tell the client that these are the compliance requirements. Now this webinar is all about corporate tax. Even though it's about corporate tax with a business license, there comes AML also into picture. If you're into real estate business, if you're into providing corporate service, CSPs, corporate service provider, if you're into accounting, bookkeeping, you are required to register in GoAML and do the compliance every year. We try to educate and create awareness for the client. If you see other corporate service providers, they just close the deal once the license is issued. They just are laid back. But when the clients go and ask them, they are like, you did not ask. But as a CSP, it is our responsibility to tell the clients that these are the compliance requirements. Now whether they wanted to do it by themselves or they want us to do it for them, that is another secondary part. But informing our clients is what we do. We are also a registered tax agency with the Federal Tax Authority in UAE. So we assist our clients in getting the registration done very quickly and very smoothly. Secondly, voluntary registration. Now, what happens when you have crossed the 3 months deadline already, when you are in the 100th day, or when you're on the fourth or fifth month of the license issuance, you go and register anyway. There is a penalty that is being levied, 10,000 dirham, of course, but that doesn't mean you stop being compliant. You show good faith. You show your intention towards the FDA that you came to know it lately, and therefore I am registering. FDA has announced a penalty waiver wherein if you file your first corporate tax return within the first 7 months of the end of the tax period, your penalty will automatically be waived off. So this is a very good initiative which businesses who have got penalties, who have been levied with 10,000 dirhams, can actually avail it and get the waiver. So now when it comes to the documents checklist, what are they? Firstly, you need to make sure you have the trade license and certificate of incorporation handy with you, along with the memorandum of association and or articles of association, the owner's identification, like if it is a non-resident person, passport copy; if it is a resident person, Emirates ID and passport copy; and lastly, the authorized signatory as per the name mentioned in the memorandum of association. So these all documents are very important when you actually go and do the corporate tax registration. And it's also very important to keep these documents handy. What happens is you have one or two from this list and you go to the FTA portal, you start registering, and then you realize you don't have the others. So you save the application as draft, thinking that you will continue when you get the remaining documents. But eventually what happens, you end up forgetting things and then getting the 10,000 dirhams penalty. So it's always very important and very significant to keep these documents handy. The most interesting and the heart of this webinar, the second part: what are the 5 conditions for qualifying free zone persons to get the 0% tax eligibility. So even before I get into this, I just want to explain briefly about what is a qualifying income, what is a free zone, what is a free zone person, what is a qualifying free zone person, which you are seeing on the screen. So if you see what is a qualifying income, any income that is being derived from qualifying activity, which we will discuss later. There are set of activities which the FTA has given. Then what is a free zone? Any geographical area as specified by the cabinet decisions in the UAE. So examples could be DMCC, Maidan free zone, uh, then IFZA. So any of these, the free zone authorities. And then what is a free zone person? Any juridical or legal person incorporated, established, or otherwise recognized in this free zone is a free zone person. And lastly, very importantly, who is a qualifying free zone person? Any legal person who is doing the qualifying activity and earning qualifying income becomes a qualifying free zone person. So now the zero rate is not automatic. Even free zones have 9% rate unless you do something which makes you 0%. So the 0% tax rate is enticing for many businesses operating within free zones. However, it is crucial to understand that merely being located in a free zone does not guarantee this benefit. Now, what should one do when they want to know whether they qualify for 0% or no? We will see one by one the points. As per Article 18 of the Federal Decree Law, there are five conditions. The first condition is maintain adequate substance in the free zone. What do you mean by substance? So it can be a workstation, office space, people, or any kind of assets. Collectively, all of this put together becomes a substance. Yeah. What do you mean by educate? Educate is basically the English meaning is anything that is reasonably sufficient to justify a point. So sometimes we get some clients wherein they say, do I qualify for 0%? They bluntly ask us. So then we ask question, what do you do? They say third port shipment, I import from China and then deliver it to Germany, the goods. Okay, then we say how many invoices do you raise? 30 to 40. How do you operate? They say flexi desk. Turnover is only like 200 to 300 million. No assets because they have people sitting in their home countries who are working from there. So substance test failed. So the moment this substance test fails, don't even go to the next four conditions of how do you qualify for 0%. Welcome to the world of 9% corporate tax. So this is basically very important that you maintain the substance in the free zone. And there is also a clause, basically if you are into distribution business, you have to be designated, you have to be located in a designated zone first of all, and you have to maintain the substance in the designated zone. So we actually saw a case wherein an entity was registered in Javza. Javza is a designated zone. Then they got NOC from Javza. They set up in Ticom. They had the office here in Ticom. They got NOC from Ticom, and then they are operating in mainland. So all these things will not work. So the substance test fails then and there, and businesses cannot avail the 0% corporate tax. It's always good to write to your authorities. So very interesting free zone is Rakesh free zone. The Rakesh free zone has designated zone and a non-designated zone in their free zone. So only the address on the letterhead will actually get to know whether it's a designated zone or not, or not a designated zone. What's the best solution? Write to the authority, write to the free zone, and ask whether you're a qualifying free zone. So once you get it in writing, then you may move on to the next point. So the next condition would be earning qualifying income. So there are a list of qualifying activities listed by the Federal Tax Authority. If you are into manufacturing business, if you are into processing, if you are a holding company, logistics, distribution business from a designated zone, reinsurance services, financing and leasing of aircraft, fund management services, all these are actually qualifying activities. There are also a list of excluded activities which have been come out. Any transactions with natural persons, if you're into banking, if you're into insurance, if you're doing finance or leasing activities, these are all excluded activities. Now, as per Article 3 of the Federal Decree Law, any qualifying free zone person, so first you have to be qualified. Yeah, any qualifying free zone person doing business with a free zone, they should make sure that they are not doing the excluded activities. What are the excluded activities? They should not be dealing with a natural person. They should not be doing banking. They should not be doing insurance. They should not be doing finance and leasing. If you are a qualifying free zone person and you are dealing with another free zone. Make sure you don't do the excluded activities. Secondly, what happens if you are a qualifying free zone person and you want to deal with a non-free zone person, who are non-free zone person, any like mainland, Dubai, mainland Abu Dhabi, and never to forget also other countries, like places like Singapore or any other country. If you are doing business with the non-free zone person, you should make sure you're doing any of the qualifying activities plus not doing the excluded activities. So what do I mean by that? Qualifying activities, the one that I listed: manufacturing, distribution, processing, wealth management funds, logistics, all this, any of this listed one, plus not doing the exclude, not dealing with natural person, not dealing with the banking, insurance, and other excluded activities. So you should keep in mind. So anything that you derive from doing this qualifying activity is called a qualifying income. So let's say I am a CSP in free zone person, and I'm dealing with PRO services only in DMCC. Yeah, in this case, I'm a qualifying free zone, and DMCC is a free zone. So in this case, this income that I have been doing is uh, is qualifying, because I'm a qualifying free zone and I'm dealing with the free another free zone. But I'm making sure that I don't do the excluded activities. So giving a CSP service is not one of the excluded activities, and therefore I am qualifying for the 0%. Let's say I'm a chartered accountant and I sell my services to a mainland company. So in this case, I'm dealing with a non-free zone, and therefore I'm not earning a qualifying income. I'm earning a non-qualifying income. The third point, and the interesting one, is not elect to be taxed under the standard regime of 9%. Why on earth would a person elect to be taxed at 9% when he's getting a relief of 0%? Yeah, this is a little confusing. But just imagine if you have an income or profit within the range of 300 or 400k, 400,000 in UAE. Electing for a qualifying a free zone person would not make sense. You should actually go and elect for the 9%, because your initial 375,000 net profit would be taxed at zero rate, and beyond that would be taxed at 9%. Yeah. And secondly, in order to avoid administrative burdens, you know that just to gain the 0% corporate tax, it's not so easy. You have to maintain a lot of paperwork. You have to maintain separate books of accounts. You have to there is a lot of administrative tasks involved. So in order to avoid this, some businesses think that let's elect for the 9% corporate tax, and just get not taxed more. Thirdly, create group, because a qualifying free zone person cannot create group. So in case if a company wants to create group, so they would elect for the 9%, and then uh, create a group in order to maybe set off losses, or uh, do any kind of tax planning or structuring. So this point basically means that it all depends on a lot of factors and internal managerial decisions whether to opt for this or not. So based on that, then the decisions will be taken. So the fourth point is complies with Article 34 and 35 of the decree law. So what does this mean? This is basically transfer pricing compliance. So uh, what is what is a transfer price? Basically, a price which you deal with your related party. Yeah. What is the arm length price? Arm length price is basically a price which you deal with your unrelated party. uh, Now, what is a related party? Basically, a juridical or a natural person who has indirectly or directly more than 50% of the ownership, or more than 50% of the voting rights, or significant influence in the profit share, and or has also fourth degree kinship, be it great grandparents or great grandchildren, or nephew or niece. So another term very important to understand is a connected person. So a connected person here means it could be a shareholder, it could be a owner, director, or officer. So now having said this, what happens when there is an absence of transfer pricing? So companies tend to collect more revenue where there's less tax in a jurisdiction, and tend to show more expenses in a higher tax jurisdiction. In order to avoid this, uh, there's a transfer pricing rule that has been introduced that companies need to comply with. So the process of transfer pricing in a very brief short term would be conducting functional analysis, doing the economic analysis, having a benchmark study, and then deciding on a price, and then using that price for the transactions. So mostly, actually, there are almost like six kind of transfer pricing methods which has been introduced. So among the traditional method, there is a comparable uncontrolled price, and resale price method, cost plus method, whereas in a non-traditional method there is transactional net margin method, profit split method, and others. So what is preferred by FDA is CUP method, so comparable uncontrolled price. So what does this mean? Like, it has two: one is internal cup and external cup. So if internal cup basically says that, let's say you're dealing with your related party, your sister company, for some kind of products or services, and you have a price. Internal cup says, if you're dealing with the same identical product or service with someone else, not your sister company but a normal business who is not related in any way to you, so what price are you dealing this with? Be it 1,000 dirhams, 2,000 dirhams, whatever the price is. So this particular price will be considered as a transfer price. Yeah. And external cup basically says that uh, any other uh, any other businesses outside your basically your competitors who are dealing with identical or similar products or services with their non-related party at whatever price it is, so you consider that price to be your arm's length price. So these are basically the methods of transfer pricing, how you get into that. It has a lot of other regulations, wherein if you have 200 million AED and above turnover, you have to maintain a local file in UAE. And if you're a part of the MNE group, that is, if you have 750 million euros and above revenue worldwide, you have to maintain a master file. So uh, this is the fourth point, that businesses need to comply with the article 34 and 35. So article 34 and 35 basically deals with the transfer pricing, which I just explained. Last but not the least, it meets any other conditions as prescribed by the minister. So what are those? Basically, first one is having your financial statements audited by an independent auditor. It's a mandated requirement. So in order to qualify for a 0% corporate tax, you always have to get this financial statements audited from an independent auditor. And secondly, de minimis rule of 5% of total revenue, or 5 million, whichever is lower. So article 4 of the cabinet decision number 100 of 2023 deals with this, wherein it says, in the second point wherein I discussed, basically a qualifying income and a non-qualifying income. So basically, your non-qualifying income should not be more than 5% or 5 million, whichever is lower. Let's take an example wherein you have a total revenue, wherein you deal with the free zone, you get qualifying income. You deal with the non-free zone, you get non-qualifying income. Let's say you have 1 million total revenue in this case. So the de minimis rule says that your non-qualifying income, that is the transactions that you have dealt with the non-free zone person, should not be more than 50,000 in this example. If your total revenue is 1 million, it should not be more, your non-qualifying income should not be more than 50,000. So if all these conditions are satisfied, then it's a green signal. You are eligible for 0% corporate tax. The de minimis safety net explained allowance limit. A qualifying free zone person may still qualify if non-qualifying income stays within the allowed limit set by the FTA, preventing disqualification. As I previously discussed, it's the 5% of the total revenue from a top level. Um, the revenue threshold, the limit is defined as lower of 5% of total revenue or 5 million, providing a buffer for small discrepancies. A risk of exceeding. Exceeding this limit results in loss of qualifying free zone status, which can impact tax obligations significantly for the current and next 4 years. It's very obvious that if in case what happens if you fail to meet one of the requirements of the five conditions, you actually end up losing it for this particular year wherein you're doing the filing, and for the next 4 years. So in total 5 years, you lose the qualifying free zone person status. The last part would be how to check if your business qualifies for a 0% corporate tax. So the costliest assumption in UAE tax is many business owners mistakenly believe that being in a free zone means they are automatically exempt from corporate tax. This misconception can lead to unexpected tax liabilities. So never assume things, never jump to conclusions, always seek expert advice. Know the law in deep. What are the conditions? What you require? What are you required to do? Even after knowing, some business owners just do not maintain healthy books of accounts. They just don't maintain separate books of accounts for a domestic PE or a foreign PE. They just try to mix it up and then create problems for themselves. So never assume things. And underestimating compliance requirements. Compliance is essential even for those assuming tax-free status. Neglecting to understand the requirements can result in penalties and financial repercussions that could have been avoided. So if you think compliance is costly, always think try non-compliance. So if you think compliance is costly, try non-compliance. So the cost of non-compliance of 10,000 dirhams penalty in corporate tax and 50,000 dirhams penalty in AML is more than the cost of compliance which you pay your CSPs or registered tax agency to get yourself compliance with the federal tax authority. So it's don't kind of think it as a cost, rather think it as a requirement which helps you to be compliant in UAE. What do you do to test whether your business genuinely qualifies for 0% corporate tax? So firstly is confirm your free zone status. So confirm it basically with your free zone authorities. As I previously mentioned, email them, get it in writing. Don't look for verbal confirmations. Verbal talks don't hold any weightage. So if you have anything in writing, that will actually act as a evidence and a proof. So write to your authorities. I'm sure you will have a relationship officer each client for each free zone, and they'll help you out with this. They'll get you connected with the right professional, and they'll give you the right confirmation from their end. Map your revenue against qualifying activities. As I discussed the list of activities, check which activity do you fall under. Very importantly, first leave tax, but commercially, are you authorized to do certain that activities? If you are doing it and you don't have it in your trade license, you it's better you actually get those activities listed in your trade license. Very important. Doing something for which you are not licensed for is also non-compliant, not from a tax point of view but from a legal point of view. So make sure that you have the right business activities, and then you do those activities. If those are qualifying, you have to map it to them. So you have to see which is a qualifying activity, that is basically you're dealing with free zone, and which is a non-qualifying income if you are dealing with the non-free zone. Apply the de minimis test, the same thing that I mentioned previously, the 5% of your total revenue, or the 5 million on a top level. So you need to calculate that and see if you are actually well compliant. You should make sure that you're not dealing with non-free zone person more. You can cap it at 5%. Make sure that you don't deal with them in a more uh, in more transactions. Verify substance and documentation. So always, how do you verify? You have uh, if you have any staff working employees, their payroll, their WPS, their visas, keep it handy with you, document it, keep it in a folder, save it in a folder, and keep it with you. Have the lease agreements, keep it with you, because this will serve as a proof that you actually had an office. Keep the utility bills with you, stating you actually paid for all this, and this is quite acts as a base for any kind of tax audits or assessments. Confirm transfer pricing compliance. As discussed in Article 34 and 35, maintain all the required local file, master file, or any kind of arm length benchmarking study that you have done, or arm length price, how you got it, the CUP method that you have applied. It's better to always have a business model created for your business and attach all the supporting documents related to any kind of research or any other details that actually act as a proof. Lastly, audit your financial statements. Very important. Each free zone, not all, maybe most of the auditors are authorized for most of the free zones here, but it's always good to go to each free zone's website and check the list of approved auditors. If your particular auditor that you want to deal with, or you have been approached by any other auditor for their services, always make sure that they are listed in that particular free zone website, just to make sure that you get it audited from the right auditor. So what happens if you don't qualify? Disqualification typically extends to the next 4 years periods, meaning businesses may face substantial tax exposure for several years, affecting cash flow and long-term planning. Yes, of course. Now you have to decide whether you want to elect for the 9% and come out of that 0% privilege, or you get chopped out automatically, lose the status for this particular year, in the present year where you're filing the corporate tax, and also for the next 4 years. So 5 years in total, you actually lose the status. So you have to do your preparation well in advance, and make sure that in order to qualify for this, you have all the required documents and you have followed all the steps. Yeah, so common pitfalls observed in UAE businesses. Mainland client misclassification. Many businesses mistakenly count mainland clients as qualifying income, risking disqualification from free zone tax benefits. Proper classification is essential to avoid unexpected tax liabilities. Any customers that you deal with, you have to make sure that they are also located in a free zone. So it need not be a qualifying free zone, but it should at least be a free zone. So mainland businesses or anything that you are dealing outside UAE would not qualify to be for the 0% corporate tax. So it will fall under the non-qualifying income. So, secondly, insufficient substance. Companies often fail to meet the substance requirements, leading to non compliance. A virtual office presence may not suffice, real operations must be established in the free zone. Uh, so, make sure that whatever you do is justifiable. Like you run an ID company with one or two stuff, that if that is justifiable, then that's fine. considering your size of the business, your revenue that you met, and all other factors. But if you're doing something very extraordinary and not so good to be true, then you are in trouble. So it's always necessary to make it look very real and justifiable with sufficient documents and evidences. Thirdly, missing documentation. Inadequate transfer pricing documentation can jeopardize qualifying free zone person status. Ensuring all related party transactions are properly documented is crucial for compliance and maintaining tax benefits. So, let's say I am dealing with my own sister company in mainland. I'm registered in a qualifying free zone, okay, and I'm dealing with my own sister company, that is a branch of my own company who is located uh, in in mainland. So I need to make sure that since I'm dealing with a domestic PE, I need to make sure that I maintain a separate books of accounts. I maintain separate documents because this particular income that I'm doing is a non-qualifying any which ways. It's not also going to be falling under the cap of the 5% margin, and it'll be a non-qualifying income. So basically you need to make sure that you maintain separate books of accounts, you maintain documents for what you are actually dealing with, maintain the proper price, maintain the methods that you have ascertained for the price, the transfer price, and all other documents. I hope you guys will stay compliant and qualified for 2026. If you have any anything, any issues or any questions as such, please feel free to drop it in the chat section. So, can I open a company virtually and claim the benefit of 0%? So, basically, it depends. So when you say company virtually, you mean in a free zone. So if that is the case, what happens is when you open a company in free zone and you don't want to maintain any kind of substance, then it kind of gets very difficult to prove for the 0% corporate tax, because you don't have sufficient substance, you don't have sufficient employees, you're the only operator, you don't have any kind of basis wherein you can qualify your business to be 0% corporate tax. What specific ERP and POS upgrades are required to comply with the mid 2026 nationwide e-invoicing mandate? So it's always advisable and it's mandatory also to appoint ASP for your business, for your accounting system. So you don't miss out on a lot of regulations, and you have all your suppliers, customers routed through this ASP channel. So in that way, you will always be compliant with the e-invoicing system in UAE. Although it has been extended until October this year, but it's always good to get it in advance. So the next question is, can I file SBR this year if I have filed a normal tax return last year? So SBR, it stands for Small Business Relief. So basically, it was introduced for the initial 3 years, 2024, 2025, 2026. So let's say you have not opted for it in the first year, and you want to file a normal tax return in the next year. So it's going to be a little it's not possible, because it's practically not possible. If you had that in mind, you should have opted it in the first year itself, and then for the consecutive next 2 years you could have thought about whether to opt it or not. So it's like, if you did not opt it the first time, you do not have any other option. If you have opted it for the first year, you will still have an option whether to go for it or not go for it for the next 2 years. If I invest in Imar properties through DFM stock exchange, is my income received through this taxable? Okay, so EMAR properties, if it is listed on a DFM, that is a local stock exchange, and you are receiving income from that, basically what I can say is dividend income. So this is basically an exempt income. So if you are receiving it individually, you're not going to get taxed any which ways, because for individuals, you are going to get taxed only on the basis of your business. If you're doing any business, any personal investments are not within the scope of corporate taxation. Now when you say, what happens if your company receives these dividends, it is still exempt. So any local dividends that has been received will make you exempt from the corporate tax perspective. We have a question, so we have set of three questions. So the first question is, if I'm a business strategist and only taking decisions from Dubai, I do not fall under the tax bracket, right? uh, so, what basically this point touches upon is place of effective management poem. So, Article 11 3B. This deals with this, wherein it says if you are taking strategic decisions from UAE, let's say you're taking some kind of decision of buying raw materials, and that your decision is final, or you're taking some kind of decisions wherein you want to do mergers and acquisitions, or these high level decisions wherein it actually affects the strategy of your business. So you will be considered a resident person in UAE, and you will be taxed on your worldwide income. Yes, you heard it right. Actually, you will be taxed on your worldwide income, because what happens is, when you take effective decisions here, the moment you do not have any kind of board meeting proofs or any kind of evidences that where it actually happened, whether it happened in UAE or whether it happened outside UAE, you cannot actually you cannot actually prove it, and then you end up becoming a resident of UAE, and you end up paying taxes on your worldwide income. Of course, when I say worldwide income, any tax which you have paid more than 9% outside of UAE, you would still get a credit for that particular income. So the second question is, if I am a US citizen working in India, I will have to pay tax only in India. So basically, US has this taxation type of taxation wherein they tax based on citizenship. It's not based on residency. So your question says you're working in India, but you're a US citizen. So you'll be taxed in US, and you'll be taxed in India. So US will tax you based on your citizenship. India will tax you based on your residency. So whatever taxes you pay in India, you can still get a credit. You can still claim the credit back there in US. So you have to just show the amount of tax that you have paid in India. I'm not really sure about the tax rates in India. So if it is technically more than the US tax rates, of course you will get a credit for that. If it is less, then you're going to pay the difference. Third, I actually have a company which I'm planning to expand in UAE. I will be considered a PE, yeah. Okay, so P basically a permanent establishment. So if you have a company already and you're planning to expand it, so basically when you kind of want to expand it here in UAE, you are any which way is going to get the license, right? So either you're going to get a free zone license, either you're going to get a mainland license. So the moment you get a license, you are a resident. There is no story of a non-resident, or there is no P as such in this case, because permanent establishment is only like if you have a fixed place where you're conducting a business for more than 6 months, you become a fixed P. Then you have a service P, wherein you send your staff to a particular country. Now, if it is UAE, you send them and you get some kind of things executed. Then you create a service P. Then you have agency P, wherein basically if a person concludes contracts on his own and who's exclusively working for you in UAE, then you become a PE here. So all this is an examples of PE, but I would say that you do not qualify to be a PE, even if it is an extension of a branch, because the moment you have apply for a branch license here, you actually become a resident. Now, when you become a resident, you will be taxed on your worldwide income, of course, subject to a lot of tax credits and other criterias in mind. Okay, guys, it was nice having this webinar with you, all of you. If you have any further questions, please feel free to scan this code and get in touch with us. I hope I answered your questions. Get in touch with us. We are a registered tax agency with the Federal Tax Authority, and we have well experienced business setup advisors who will assist you guys in setting up the business the right way with proper structuring and planning. Thank you, one and all.